here in this case, if they do really well during the vesting period, they can actually afford not to do that well at the end. Again, this is also easy to price, since it is based on averages. Okay, now let's think about how to punish you. Suppose I want to punish execs for their performance during the vesting period. Assume price is 100 on grant date. If X bar V is less than let's call this floor, I don't know, maybe 70. I mean, firm can decide what that should be. You know, figuring out the optimal number is way beyond the scope of even a graduate class in derivatives, but I would probably do it in a PhD class. It's actually a rather interesting optimization problem, but it's very, very technical. I'm basically going to say if at the end of vesting periods, then option ceases to exist. You can also make that gradual. You can say maybe first year average is less than, I don't know, 50. Sometimes things go really wrong for no fault of your own, or second year average or 2-year average less than 60, or 3-year average less than 70. This would be another example of, I mean, if you do so bad during your first year, the average stock price is half of what it is started. I'm going to tell you, you don't have that option anymore. I'm penalizing you. Or during 2 years, you lost 40%. During 3 years, you lost 30%. I'm kicking you out. Not necessarily off the company, but you don't have those options anymore. We could also have knockout features. After vesting, but they would not add too much to the punishment mix. I mean, technically speaking, I'm paying you for the performance during the vesting period. So the penalties that I design or the punishment that I design should also relate to vesting period. If you want to incentivize them, you can have knock-in clauses. For example, if the 3-year average does not exceed 130, your option does not exist anymore. It's basically 10% a year, right? Again, that 30 number that I'm using is completely arbitrary, okay? Or you can do gradual knock-in. Just because your option didn't knock in during the vesting period, I don't want to exclude the possibility it never would. Example, option knocks in if 3-year average is, let's say, greater than, let's say 115, assuming 5% T-bill rate. That's basically essentially performance of T-bills, or etc. I'm basically giving you 2 or more years chance of option knocks in. Obviously, if it knocks in, it stays knocked in. If it knocks in the first 3 years, the others are irrelevant anyway. And these are all easily priceable. Using the Monte Carlo simulation methods. The benefits are quite a bit for the corporation. 1A, it's going to eliminate the entire idea of executives deciding what their payoff is going to be. The option has a formula and that's it. So executives don't have to worry about that. Whatever they do, it's not their decision what the payment is going to be. And 2, anytime you have averages like that, it reduces the value of the option. Remember, by GAAP, these options have to be expensed, right? You value them at the grant time, and you amortize that value as delayed compensation expense over the vesting period. Whenever you have averaging, the value of that option goes down. That means firms actually have higher profits. So it actually works better for the firm. Anytime you have knockout features, that reduces options value even further. And that means even less expense, but more importantly, my executives know that they can't simply rely on projects that's going to perform really well in 10 years. Remember, one of the reasons you give them for long periods, you want to give your executives incentives to take on long-term projects that are risky. Things that's going to pay off in 2, 3, 5 years, but that are also risky because they get the upside. But you don't want them to take on too many long-term projects either. Remember, shareholders are a finicky bunch, and sometimes your share price is your biggest capital source. Even if you can't borrow cheaply, you can always issue new shares and raise capital, right? And a lot of the investors in the market, they don't have a 10-year investment horizon. 1, 2, 3 at most. So you want to give your guys an incentive to take on projects that's going to show themselves up maybe in 3 years. So, but if they do really bad in 3 years, I want to penalize them. What's that threshold? Who knows? I mean, there's kind of a trade-off. The lower is that threshold, it's ineffective. If you say 50, I mean, if these guys lost half of the firm value in 3 years, you don't want them to begin with anyway. If you make it too high, that's gonna channel the executives into taking really short-term risk. You don't want that either. What's the optimal balance? Again, that's not the topic of this class or graduate class. There's all sorts of nonlinear programming that goes into that. And this way, you can even hedge the risk of these easily, okay? Because what a lot of firms don't do, they do not actually hedge the risk of executive stock options. I mean, think about Tesla. These guys had ESOs that were expiring last year with a strike price of $2 and stock was trading over 300. If that means when they're exercised, they're actually realizing a big loss, right? Well, if they actually hedge that risk, they wouldn't have worried about that. And firms can buy and sell options on their own stock. I mean, years ago, there was a firm, Viropharma, I think. I had that as a case study in an MBA class. These guys wanted to raise some capital, but it wasn't easy. So they went to Goldman Sachs, and they said, we're going to write a call option on our own stock. Oh, I'm sorry, we're going to buy a call option on our own stock. And yeah, they bought a call option on their own stock, but they gave some of the upside to Goldman Sachs for financing purposes. You can do all sorts of exciting things with these derivatives. But we kind of got rid of all sorts of compliance issues, legal issues. Why should my executives worry about legal cost of all of that? They shouldn't have to. And by designing a product, you can actually get out of that. All right. On Monday, we're going to kind of price just two of these. I'm going to price the double average one, where the payoff depends upon the average during the vesting period and average at the end. And we will also put in knock-in and knockout features to that one. All right. And you will see how easy to value those things. And we'll compare it to the expense of regular stock options. I'll see you guys on Monday.